So what we're here to discuss today is turning bad deals into great situations. And what I want to start by saying is I want to acknowledge that, well, as part of this speech, I'm going to talk about complex deals and what we'll call easy deals or less complex deals. But I acknowledge that M&A professionals constantly see difficult and complex transactions. Even the easiest of deals have some complexity to them, whether that be something regarding the outstanding lease or something from a valuation standpoint. There are 1,000 different variations to every transaction. Every transaction is different, and M&A professionals are constantly facing difficult obstacles when it comes to closing any sort of transaction. And because of that, we see a lot that M&A professionals stay away from what they deem to be unnecessary additional complications as an effort to try to make sure they close as many of their deals as possible. In the distress space, this often is tied to subordinate debt, meaning that there is either too much debt in a target acquisition or the complexities of the short sale make it difficult to get to a closing. So there will be multiple creditors, which may require multiple consents. So even if you are able to cram down the underlying value of the debt in order to get a transaction done, the ability to coordinate all of the approvals and necessary cooperation in order to get to a final closing hinders or disqualifies any potential lead. The flip side of that is the many sellers in that situation list their business for the value of their outstanding debt, even if the underlying business operation doesn't support that type of valuation. So either the valuation is in line, but the complexities towards getting through a traditional short sale make the deal impossible or seemingly impossible, or the deal is impossible because the expectation of pricing is too high because people want to sell for above and beyond their outstanding debt. And in the distress space, the underlying value of the business won't support that. With Second Wind Consultants, we believe we have an ability to solve that problem and turn complex deals into deals that are saleable commodities that can close with relative ease given the complexity of any transaction. At Second Wind Consultants, we deploy the Article 9 strategic short sale. And I'll get into more of what that is later, but the reasons that we do that is to divorce the debt from the underlying value of the business, to streamline the process of the short sale in order to require only the consent of one creditor, which is the first position creditor, and reduce the minimum pricing to the amount of the liquidation value of the assets. So what the Article 9 does is preserves the underlying value. It allows buyers to come in at a reduced purchase price aligned with the underlying value of the assets and allows any additional earnings to be paid out over time in some sort of variable performance-based component. And the complexities of a traditional short sale are streamlined by only having to deal with and get consents from one creditor. Very briefly, I want to stop and talk about Second Wind, who we are, where we came from, and how we stumbled across being experts in the strategic Article 9 short sale process. Second Wind Consultants is a consultancy for the small and middle market companies focusing on debt elimination by conducting strategic short sales. We conduct a variety of different short sales for all different types of collateral, from commercial real estate to any type of business personal property that you can think of. We specialize in the Article 9 UCC sale because it covers most types of collateral, although we will conduct short sales on a variety of different collateral structures and debt types. Second Wind Consultants was founded just over 10 years ago by attorneys who once practiced in bankruptcy law. And our genesis came from our founders being bankruptcy practitioners and seeing the failures of a Chapter 11 system over and over and over. They would bring clients into a Chapter 11, and the vast majority of times those clients would exit that process without getting the relief they sought when they initially started. It is known that about 75% of all Chapter 11 filings fail to get to a successful discharge, and this results in unnecessary liquidation of thousands of businesses every year, tens of thousands of businesses every year. And from this, our founders became exceptionally frustrated and decided that there had to be another way. And over the past decade, we've done thousands of transactions in an effort to streamline that process and preserve the underlying value of a business without having to go through the traditional means of liquidation. So we believe that in any distressed situation that there is remaining underlying value. We use this analogy a lot in our office, but if someone falls behind on their mortgage, the mortgage company doesn't bulldoze the house. The house has remaining value that can be used to pay down the underlying debt. In our current regulatory climate, we've created in the business realm a pay or fail dichotomy, because the process of a Chapter 11 filing or complex liquidation yields all parties a really difficult outcome. Businesses need to be shut down in order to be liquidated by secured creditors. Therefore, when you shut down a business, its underlying value evaporates. And we believe that there has to be a better way. There has to be a middle ground where you can preserve a business's value while making sure you're maximizing the value to all of the stakeholders. And that is what a streamlined short sale accomplishes. So yet again, what is a bad deal? Let's define it. Let's further define what a bad deal is. I can bring that down into three statements. One is the market value of a business is less than the debt owed. So you go in to either a target acquisition or a potential listing, you do a market valuation on a business based on its historical performance and recent market sales, and you come to a market valuation, and that market valuation is less than the debt owed on the company's balance sheet. Essentially put, this is your classic short sale. Another option of a bad deal is the cash flow of a business does not support the debt service. So the business may not be in traditional terms over-leveraged, but because it cannot pay the debt it has as agreed, it is in a status of default and therefore is a distressed obligation. Lastly is the asset value of a business is less than the debt owed by the business. So this is very similar to the first one, but just in that the hard asset value is also less than the outstanding business debt, and therefore the business is, for accounting principles, insolvent. So our solution to that is that through a streamlined short sale process, you can bring Second Wind Consultants a business with good top-line revenue and strong margins, and we can reorganize that business through a streamlined short sale and provide it back to the M&A professional as a saleable commodity in a matter of weeks. So that allows an M&A transactionalist to value opportunities based on revenue, gross margins, and EBITDA, and not based on the complexities of a balance sheet, which may have a large capital stack on it, which would be, under other circumstances, difficult to navigate. How we do this is, as I've discussed, through the Article 9 UCC sale. The Article 9 is part of the Uniform Commercial Code, and the Uniform Commercial Code regulates the flow of goods and services between businesses. I'm assuming that most people on this webinar have conducted at least some transactions, and it would be difficult to get through any transaction without having to have come across the Uniform Commercial Code. The Uniform Commercial Code allows lenders to file liens or UCC1s on their collateral in order to protect their security interest. And Article 9 of the UCC provides a provision that first position UCC holders, also known as lenders, the ability to sell the assets which consist of any liens and encumbrances without the need for litigation and foreclosure. So this article of the Uniform Commercial Code is built in for the benefit of secured creditors, specifically first position perfected secured creditors. And what it does is it allows them to send notice to subordinate UCC holders that they are going to dispose of the collateral through a private sale. That notice is only sent to subordinate UCC holders, and the transaction is conducted in most cases as a private sale. At the end of the 10-day notice, if none of the subordinate creditors have responded to that notice period, then the assets are sold free and clear, and the UCC positions that were on the assets are terminated by way of the Article 9 of the Uniform Commercial Code. We have done thousands of these transactions, and there is recourse for subordinate creditors. Subordinate creditors only in that 10-day period can challenge the underlying value of the transaction. And which I'll get into in a few minutes, in order to conduct an Article 9 properly, the value of the transaction has to be verified as adequate consideration before the entire process begins. So process is a bit self-regulating, because while subordinate creditors can challenge the transaction in the 10-day period, if the transaction was conducted properly, their only ability to challenge the transaction will have been predetermined, and therefore the vast majority, if not virtually all, Article 9 sales will close immediately after the 10-day noticing period. The results from an Article 9 sale we call win-win, win-win-win. I'm sure you all have heard of the win-win scenario. Well, this is the win-win, win-win-win scenario. And let me break it down for you as to why that is. We believe in most of these transactions, and some might be the exception to the rule where there are other stakeholders, but there are 5 main stakeholders in any Article 9 transaction, and all of them stand to receive benefit from the conducting an Article 9 transaction versus the alternatives in the distress space. The first party is the first position secured creditor. They benefit because they are able to sell their collateral for appraised value with no expenses other than minor legal fees associated with the transaction, and no long foreclosure process and no expensive auction process, which may result in no one buying the collateral to begin with. So the first position creditor is able to sell its collateral for an agreed upon value with very little friction and very little cost. The seller is the second party, and they also win because they create a successful exit where they otherwise couldn't. When they first came to the M&A advisor, their valuation was less than the debt outstanding. They knew they needed an exit. They didn't know how to get through that exit. By conducting an Article 9 sale, you're able to sell the assets of the business in a short sale scenario, and because the entry price is crammed down to the forced liquidation value of the business's assets, it creates an opportunity for the seller to obtain some of that additional value, either through a consulting agreement, or potentially an earnout, something of that nature, which allows them to create a successful exit that both addresses their debt and allows them to earn from the transaction. The third party is the buyer. The buyer was able to acquire a business that they would have otherwise passed over in the traditional M&A space, and they were able to enter based on the value of the business's assets. Article 9 sales only require an upfront capital injection equal to the appraised value of the business's assets. Any additional value that they've applied to the acquisition is given to the seller, as previously discussed, in some sort of variable earnout. So if that variable earnout is actually performed, it means that the buyer was able to enter in at an attractive price and they hit their ROI targets. If for whatever reason the acquisition doesn't go as planned, they've only entered in at the value of the assets and can exit that opportunity with very little downside risk. The fourth party involved here are all of these subordinate creditors. These creditors are, whether they're banks or vendors or any of the like, are able to write off toxic assets on their balance sheets. So rather than carrying these ongoing assets, which if you're a federally regulated financial institution could have some regulatory issues, or to have a falsely inflated balance sheet, these creditors are able to bring conclusion to this, write off the debt, take the tax benefit from it. And if they are a vendor, then because we've been able to preserve the value of the business and the business continues on under a new entity and ownership, that vendor has an opportunity to preserve the future business relationship because the business still exists. And last, and certainly not least, is the M&A professional. The M&A professional wins because they were able to close a transaction that they would have otherwise passed on and not been able to capitalize on. And it creates a level of differentiation and a competitive advantage within their market by being the M&A professional that knows how to navigate difficult and complex deals. So between earning off of a deal that would have otherwise been passed on and establishing yourself as a savvy M&A investor who knows how to handle complex deals, the two have a compounding effect and are our fifth win in this environment. So I think it's valuable if we take some time to go through an example. So I have a fact pattern up here. While this does look like somebody's name, it is somebody. This is all made up just for the practical application here. But let's say you were representing a buyer, a strategic buyer, potentially a private equity group who is looking to seek add-ons to their existing portfolio. They deal in manufacturing, and you find Larry Lancaster's manufacturing company in Ohio. Based on its geographic location and the customers it serves and its relative financial performance, it would be a great fit for your buyer. However, you come in, you meet with Larry, you have some initial conversations with him, sign NDAs, and do some due diligence. And what you find out is that Larry's business has a current market value of $3 million. Its underlying hard asset valuation is $2 million. Which all so far so good. However, a review of the balance sheet shows that Larry Lancaster's manufacturing company has $5 million worth of total debt. $2.5 million owed to an SBA secured creditor in first position, and $2.5 million spread across a variety of subordinate secured creditors. How we would go about this transaction, rather than just passing on it, because it's an obvious short sale, $3 million valuation and a $5 million debt load, we would conduct an Article 9 sale with the first position creditor, in this case, the SBA bank. We would arrange a sale based on the asset value of roughly $2 million that would allow the SBA bank to conduct an Article 9 sale and receive all $2 million from that transaction, which nearly pays off the amount of debt that is owed to them. This would allow your buyer, your private equity group, to enter in at a $2 million purchase price, acknowledging that the market valuation is $3 million at the time of purchase. That delta can then be put into a $1 million either consulting agreement or earnout, which is based on performance for Larry. Larry stays on as part of the management, runs the company, or helps with the management of the company. And if he hits certain benchmarks, whether it's revenue or profitability, Larry will earn $1 million through his consulting agreement and or earnout. The SBA bank gets to liquidate, like I said, because it's an SBA bank, they get their guarantee. And the additional compensation goes to Larry through a variable earnout. And that is also what gives Larry $1 million in which to address the remaining debt that is outstanding. If Larry personally guaranteed any of the remaining debt that was not addressed as part of the sale, he's going to need to settle his outstanding personal guarantees. And without having some means in which to do that, Larry would have found himself being insolvent and likely wouldn't have done this deal to begin with. So by being able to structure an Article 9 sale, which is in the benefit of all of the parties involved, we facilitated the first position creditor in liquidating for their benefit, which is probably what they were going to do anyway. We've gotten Larry an incentive to go through this transaction. And so he's willing to come along because he knows that he can both create a successful exit, earn, and have a path in which he doesn't have to file a bankruptcy. And this is where a lot of transactionalists in the distress space miss a key component here. Larry, if he's going to file a bankruptcy, is probably going to file a bankruptcy before he sells his business. The only reason he would sell his business is if there was a way for him to avoid that level of insolvency or filing a bankruptcy. Using the Article 9 and getting him a vehicle in which he can avoid that bankruptcy creates the seller incentive. So rather than just filing the Chapter 7 and liquidating the business in total because the business is insolvent and Larry personally guaranteed all of the debt, this structure facilitates an end result where the buyer buys at an attractive entry price. Larry creates an exit. He has an ability to earn, which allows him to settle his personal guarantees and avoid a bankruptcy. The first position creditor gets the proceeds of the $2 million asset sale, and all of the creditors, whether it's first position, subordinate position, stand to get some sort of settlement from Larry because he has the $1 million variable earnout and therefore has an ability in which to address those debts. So all of those parties benefited from this transaction, not to mention the M&A transactionalist who was able to bring a company that is a good add-on to their buyer who they represented in a buy-side representation. So, as I said before, there are qualifications. Many of you might be thinking, well, this could be used just to abuse subordinate debt holders and subordinate creditors and just used as a way to not pay outstanding obligations. And I said to you before that this was a bit of a self-regulating system, and I want to go into why that is right now. So, as I stated before, Article 9 sale requires adequate consideration for the assets being sold. This is done by conducting appraisals where appropriate and actually making sure that the valuation of the business or the business assets is accounted for in the Article 9 sale. So if the asset value outweighs the value of a debt owed to a security, that if the Article 9 is done appropriately, it would not be able to be sold for less than adequate consideration, meaning that there would be additional funds available for the subordinate creditors. So because adequate consideration is requirement of this, and it has to be done by third-party appraisals, there isn't an option to use the Article 9 in order to sell assets for less than what they are worth in order to avoid paying the subordinate debts. Also, one of the requirements is that the borrowing business, or the debtor in this case, must not have the asset base or income to support full repayment of the debt. So a company that has more assets than the outstanding debt, again, we just addressed that. If you get those assets appraised, it's going to show that they have more than enough to pay their outstanding obligations. And an Article 9 would just facilitate all of the creditors getting paid in full if that were the actual situation. Likewise, if a business has the ability to repay its debts, it therefore has the assets in form of intangible assets, and they will also not qualify for an Article 9 sale. Last component of qualifications is the 10-day subordinate notice to creditors, which gives all of the subordinate creditors an adequate period of time to challenge this accounting under the transaction. So if the first position creditor didn't obtain appraisals or didn't go through the process to make sure adequate consideration was part of the transaction, that is what this 10-day notice period allows subordinate creditors to do. Technically speaking, in that 10-day period, it also gives them an ability to foreclose up and take over first position. But due to the fact that this is a short sale, that also virtually never happens because there's not a financial incentive for subordinate creditors to do that. So the 10-day or otherwise 2-week noticing period gives subordinate creditors a reasonable amount of time to make sure adequate consideration was part of the transaction, and therefore the transaction would withstand legal scrutiny. So on a whole, what this means and what we believe is that the transactional space is changing. The landscape is changing. There is, regardless of how easy deals get, there are complexity in them, and through things such as technology and platforms, axial merger network, biz buy sell, access to deals is becoming easier and easier. And access to the deals that are deemed easy, it's even getting more and more competitive. There have been a significant amount of additional M&A firms, individuals, transactionalists, business brokers that have entered the market in the past 10 years. And over that period of time, the deals that seem or appear easy, although again, I acknowledge none are completely easy, but the ones that are, and there is a lot of technology on the horizon that are trying to automate that service as much as possible. So getting through due diligence now and initial NDAs, initial LOIs, and first contracts, all of those things can be done on technology platforms where in previous years they weren't able to. So what this means is that if you're on this call or you're part of the M&A sources, is that the landscape is changing. And in order to be able to keep a competitive advantage and be an active player within the M&A space, relying only on the quote unquote easy deals is really no longer an option. Figuring out how to do the hard deals, not fearing the short sales, for example, is what is going to create a level of differentiation and competitive advantage. And we believe at Second Wind, those who do not figure out how to embrace this level of the complexity are likely to be pushed out of the market in the coming months and years. To add to that, economic conditions have continued to improve. We're on an economic run that we have not seen in most of our lifetimes. And there are many economists and other figureheads that are predicting a coming correction in the upcoming months and years. And depending on which specialist or figurehead you're listening to, you get a variety of different timelines around that. But one thing that we can all agree on is economic conditions have always been cyclical and will always remain cyclical. So we have been on an unprecedented growth curve, but that will correct itself. And in times of corrections, there become less and less traditional going concern, easy opportunities, and more distressed opportunities. Those of you that were doing this 10 years ago during the last economic crisis know exactly what I'm talking about when it comes to the mix of deal flow in times of distress. Once the correction does occur, between the automation and saturation for easy deals and the plethora of complex deals, navigating difficult business transactions will be the competitive advantage that every M&A nationalist will need in order to be successful. Otherwise, you'll find yourself in a position that where you slowly lose market shares to those who do know how to navigate the difficult situations. So, in conclusion, and I'll leave some time for some question and answer at the end of this, Automation, industry saturation, and expected market corrections require that business brokers and intermediaries handle complex deals such as short sales. If you have a partnership with Second Wind Consultants, what that partnership will allow you to do is value businesses based on top line revenue and gross margins, and as well as cash flow and EBITDA, without having to weed out deals based on the debt that is present on the balance sheet. And this will vastly expand deal flow. This will also create a competitive advantage for M&A professionals that allow you to compete in an evolving market and really allow you to bring value to your buyers and sellers by creating exits where there wasn't one and creating attractive entry prices for purchasers where deals were once seemed impossible. So by us backing your relationship, you're able to pass forward those value adds and create a competitive advantage for yourself that will differentiate those you from your colleagues. So right here is our contact information. That is my direct email. You can feel free to email me any questions if you have questions that are maybe confidential in nature or just complex and should be discussed potentially offline. Likewise, that 800 number will put you through to our main office and intake line, which we will be able to either schedule a time directly with me or one of our strategists or team members here to be able to go over either what we discussed on this webinar in more detail or go over specific fact patterns if that is more relevant to you. That being said, I think I'm going to pass the controls back and open the floor for some Q&A if there are any outstanding questions.
Thank you, Adam. We do have a question out here. It's got a couple parts to it. How is unsecured trade vendors typically dealt with here? Are they subject to the 10-day notice? And what if a buyer wants to continue doing business with some of them?
That's a great question. So I'm going to try to break that down. The first part of that question was, how are they dealt with and are they subject to the notice? So if some vendor relationships do require a UCC file, the only parties that get a notice of the sale are those who hold UCCs. So if a vendor does not have a UCC on a debtor business, it is not entitled to notice. It doesn't mean that we can't notice them as practice and keep them informed if they are a key vendor, but per Article 9, they are not required to receive that notice. So simply put, they are not noticed as part of the transaction unless there's a strategic reason in which to send notice to them. If the new business if the new owner wants to continue to do business with those vendors, they are not financially obligated to any of the previous entity's debt and have no obligation to assume any of the previous vendor debt. In the vast majority of cases, we see the new operating entity create a new ordering relationship under their new EIN and begin just a brand new ordering relationship, whether that's COD or not, in order to separate themselves from the existing debt. That being said, this is not a bankruptcy filing, and the buyers are willing to do whatever they feel is in their best interest. So if they feel that they want to continue to do business with certain vendors and not others, if they want to pay some past due obligations and not others, they have the ability in which to go through that process and make sure that those relationships are secured prior to closing. Because that's ultimately, when you're talking about vendors, it's about making sure your supply chain is smooth post-transaction. So the buyer gets a level of discretion here, although the important part is there is no obligation to pay any of the previous past due debt, and in most cases, a new ordering relationship is established and the business just goes on under that new relationship.
Thank you. Our next question, so the M&A advisor would have to be paid by the buyer?
Yeah, I mean, there's a variety of different ways that we can do this. So if it depends on if it's going to be buy-side or sell-side representation. So if you have somebody that comes to you that wants to sell their business, but they cannot due to the fact that they qualify as a bad deal, many M&A professionals will send that lead to us, and we will reorganize the business through an Article 9 sale, and then basically give that entity back to them to list without the complexity of the debt. So an Article 9 can be done just to strip off the debt and reorganize the company into a new entity, and then that entity can be listed as what I would call a quote-unquote easy deal. It is no longer a short sale. We've already removed the debt, and the new entity can be sold in the due course of business. Under those situations, and again, that process on average takes 45 to 60 days. So you bring us a target listing that you would normally pass on, we turn it around in 4 to 6 weeks and give it back to you to list as a going concern business with all of the complexities removed. And the M&A professional in that scenario would get paid as they would in any normal transaction, out of closing as it would originally stand. If there are several other options, we can do the Article 9 directly to strategic purchasers. So again, if you're representing a private equity group, then you're doing some buy-side representation. We would go right in and do the Article 9 from the seller to your buyer. There's no need for that intermediary step. And so we could make sure that the fees would be out of closing, and whether those fees are split between buyer and seller, that would be part of the negotiation. And the overall compensation can be included as part of the scope of work for the M&A professional. So just because we're selling the business for the value of its assets, if there is an earnout or something of that nature, that can be subject to the overall compensation for the transaction, and the M&A person can earn off of that. So the short answer is there's a variety of different ways to do that, from repackaging a bad deal into a good one so that you can do it what you do in the normal course of business, or creating some sort of agreement between buyer and or seller to share the fees based on a total compensation package of an Article 9 sale.
Thank you, Adam. I think you might have touched on this a little bit in your most recent answer. But how can Larry, as a current equity holder, get an earnout if he jumped in front of the unsecured and some of the sub-debt?
Well, it depends on the situation. So if Larry is going to continue to operate or operate the business, he is going to apply value to the business, and therefore is entitled to compensation as an employee. Compensation as employee does not become subject to previous debt filings. It's just a different class of income. So if you own a distressed business and you sell it through a short sale, you are entitled to work for and earn from the new company, even though you have other outstanding debts that were not compensated as part of the acquisition. So that is typically touched on either through a consulting agreement or an earn-out scenario. In certain situations, because the business was done through an asset sale, anyone who does not have a secured interest in the assets would not supersede someone's ability to have an earn-out. So an earn-out can be appropriate given the right capital stack, but in the vast majority of cases, these are done through consulting agreements, which falls under employment, which is not subject to previous debtors, or sorry, previous creditors.
Our next question, is there a size range that works best?
We've done these as small, for debts as small as $100,000. I would tell you that While it certainly works at that level, the larger the organization, the more value can be brought out of an Article 9 sale. But we do these as low as $100,000 in debt to as much as tens of millions in debt, depending on the size of the organization. It's more when it comes to that size, when you're dealing with a business who is insolvent at wit and they only have a few $100,000 of debt, their underlying value will probably attract less purchasers. So it's more about supply and demand at deal size. What this does is take a bad deal and put it and turn it into it turns it into a great situation. It makes it just like every other listing that you have because it's removed the complexity. So if you're good at selling businesses with a valuation of only a few $100,000, then this will work for you by taking small deals and packaging them into bigger deals. But it won't affect the market's condition as to whether or not someone wants to buy a $300,000 business versus a $30 million business.
Thank you, Adam. That looks like all the questions we have in for now. Please reach out to Adam or to myself, Laura Wright, Wright at masource.org if you have any follow-up questions or would like to be connected with Adam or Second Winds. Thank you all for joining us today, and thank you for sharing your time and your knowledge with our members, Adam.
Yeah, I appreciate it. And I encourage everyone to feel free to reach out either to that email or that phone number that was on the last slide. And our office would love to hear from you and are more than willing to sign any sort of NDA or confidentiality agreement pre-conversation if necessary, or just be able to discuss these things without having to discuss any confidential information. So I appreciate everybody's time and looking forward to following up with you guys from here.